Michelle McKinnon. She's a senior wealth advisor at Payne Capital Management. Michelle, welcome to the watch list. And as George and I were talking about, this Monday whiplash, is there a trade deal, right? And then the second question is, should we get anything in place? Who's to say if either side will adhere to it?
Yes, so I think this Monday was a telltale sign of probably what's going to happen in the future. And I certainly wouldn't encourage investors to assume that the headline is truth. If we do in fact get a even further escalation or further deal, we really don't know the specifics, and also both parties seem to be very wishy-washy, particularly China this morning. So I think more importantly, we need to look at earnings. What is earnings season going to look like? And that should hopefully propel stocks further. Because going into earnings, they definitely don't look great. However, analysts tend to underestimate. So who knows, maybe we'll have some nice surprises in the positive.
I think it's really tough, the 3 to 4 weeks where you're in the earnings vacuum,
yes,
and the market's so hyper-focused on macro headlines. Volume tends to be a little bit lower. I think it will be a welcome shift for analysts, portfolio managers, and traders to have something else to focus on and get back to the fundamentals, because we need to get some clarity in terms of what forward guidance is going to look like. And I feel like what's happening with the China and U.S. and global trade uncertainty, it's really hard for them to be able to say what their OPEX is going to look like, what their investments are going to look in order to drive future growth. Share buybacks are one thing for stock price, but it does not mean that it's
right. It doesn't mean future growth. Yeah, I totally agree with you. I think it's important that, if you're a long-term investor, these type of sell-offs are opportunities, right? And the majority of my clients are long-term, so I can feel confident saying buy the dip, valuations are reasonable. Yes, we're in a sluggish growth period, but just because we have slower growth does not mean a recession. I think short-term, it's tough. However, I would look for those stocks that have yield, and not the normal ones that everyone's buying into. But particularly, I would like energy master limited partnerships, MLPs, because they are coming off of a harsh sell-off in 2015, 2016, and they give anywhere between a 5 to 10% dividend. So even if the price goes nowhere, you at least still have a healthy return via the yield, so you can kind of ride out this storm no matter what happens.
Yeah, and you're going to be great value play with the energy sector as well,
absolutely.
It has been beaten down so much. But you bring up a great point there too. When we talk about what's happening day to day, you have to think about your time frame and your point of reference, because that's what's really key. For a longer-term investor, these ups and downs could be very welcome if you're acquiring 401k shares at a much more attractive value, as you were saying too, using this opportunity to pick up some shares in the energy sector that have been beaten down. And at the end of the day, slowing but growing, there are still some positive signs in the economy, in the U.S. at least.
Yes, I mean, the consumer continues to, I think, surprise all of us. Those jobs numbers a couple weeks ago was very much a sigh of relief that they are still strong. And certainly something that would concern me is if we started to see layoffs. And you would probably start to see that as hiring would slow down, and then you would see layoffs. So as long as we can keep hiring at a healthy pace and you don't see layoffs, I think the consumer is going to keep strong, and hopefully we'll push this through kind of the sluggish period in manufacturing.
All right, now what about the Fed and global central banks? I mean, everyone's in negative yields with the exception of us, which could be why we're continuing to see the outperformance in U.S. equities, because that's really you're getting your yield from.
Yes, absolutely. I think, whether the Fed lowers again, that's a hard call. I think that has dramatically changed the percentages of what the market's expecting. However, I think a positive of all this global easing is, again, the globe is easing. Versus a couple of years ago, you had a lot of central banks pulling back, and now pretty much everyone's easing. So I think that's an absolute positive for global markets.
All right, now what do you think about valuations at this level? Because even though the headlines might be coming out really quick and the administration's coming out with tweets, and we look at it, and really from 12 months to 18 months back, we really are at the same level where we started from. That said, yes, if all you bought was the S&P, you're flat on the year. But if you looked for certain sectors and certain stocks, you've done pretty well.
Yes, you have done pretty well. And I think, again, coming back to those yields, even though prices have been flat, if you were able to capture some stocks that have a healthy yield, you're actually doing well. And then, of course, have the bond component with bond prices rallying. I would say in terms of valuations, of course, the tech sector seems a little overvalued. Now, I'm in the camp that you probably should be taking profits from tech, but you still need tech in your portfolio, because often what led you into the rally in 2008, 2009 was tech, and that's probably going to lead you out of the rally. So you need to have tech in the portfolio. But in terms of the broader market, I mean, 17 and a half times forward earnings, that's not terribly overpriced.
Right. What sectors would you look to rotate into?
I would say, again, you want to be diversified, but take advantage. I know the valuations and value, like everyone has been saying, they do look attractive. You also get the yield. I certainly wouldn't shy away from emerging markets and even Europe. Yes, there's absolutely some negative headlines. However, you get a better yield, you get a better valuation, and particularly if you're a long-term investor, you need to make sure that you have those global markets. Because let's face it, the U.S. is 5% of the globe's population. We're 20% of its GDP, and we're 50% of its market cap. That might not always be the same.
Yeah, all right, so we have 30 seconds to go here. The big banks kick off earnings season officially this week. That's been a sector that is kind of struggling with the low interest rates.
Yeah, I think it's really important to hear what the big banks say about consumers. Yes, you need to have them in your portfolio. I'm probably not the best person to say should you be over or underweighted banks, but I think you need to be listening for signs of what they see in the consumer.
All right, thank you so much. Thanks for joining us on the watch list. All right, thanks to Jill McKinnon. She's a senior wealth advisor at Payne Capital Management.